Good evening to you all, accounting Boffins, and welcome to it. This is your favorite show, a show where you learn more and learn extra. On a lovely Thursday, we're doing accounting, of course. My name is Abram, and of course, today we are the A Squared team. Ashraf is in the building. How are you, Ashraf?
Good, Abram, and you are well today?
I'm well. I can't
Great,
complain.
you look
All is good.
jubilant. You look excited about the show.
I am. I mean, I'm always looking forward to your shows. I
No,
learn
brilliant.
so much. And
Thank
you know,
you.
accounting is one of my favorite subjects.
Absolutely, absolutely. And I
What
hope,
yeah?
I hope our grade 12s love accounting as much as you love accounting.
I know they do. Trust me. They've been waiting
Good.
for this show.
Brilliant.
What are we doing?
Today we're looking at financial indicators. A bugbear. Many candidates feel that they don't really understand what they have to do. So the place to be is Learn Extra, because we're going to show you exactly how to look at financial indicators and how to go about answering questions with financial indicators. Sometimes also you refer to it as ratios. One and the same thing. Financial indicators it is today.
Of course. Well, guys, to join us, simply download your notes or get the viewing option. I've already posted them for you on facebook.com/Learn Extra. Like our Facebook page, share it with your friends, even your teacher. Tell him or her to come like our Facebook page and also be a part of our family. Otherwise, you can follow us on Twitter @Learn Extra. Remember, the notes are all available on learn.mindset.co.za. And one last more thing, you could get yourself an accounting workbook for only 139 Rand. Simply send an email to sales@mindset.co.za. The questions that Ashraf is going over are on the workbook with solutions, of course. So if you want to know more, ask me. I am on facebook.com/Learn Extra. Over to you, Ashraf.
Good. You said you had a question for me?
Yes, I had a question from you.
Good.
This question was posted actually on our YouTube by Tapelo Matebele.
All right.
Tapelo says, if you recorded an overstated check in your CPJ, where would you correct it?
Okay, guys, that's dealing with bank reconciliation statements. Right, what does it mean? If you record an overstated check in your cash payments journal, remember, the check has been overstated, the check is incorrect in your cash payments journal, you find out the correct amount, the difference between the two is what you will now record in your cash receipts journal. And by doing that, you've now brought that amount down to what it's supposed to be, and obviously that would then correspond with what appears in your bank statement. Answer the question.
Hundreds.
Hundreds. Good. Can we go on to financial
Yes, let's
indicators?
continue.
Thanks, thanks, AB. Okay, guys, with regards to your financial indicators, what do we know? When you're analyzing your financial indicators, it is an important skill, right, that you need to develop, and the questions usually require you to both calculate and comment on the financial indicators. Now, this is very important. One is to be able to calculate the financial indicator, and secondly, you must be able to comment on that financial indicator. Remember, here we've got some hints for you. Let's look at our hints. What do we have for you? One, learn the formulas for each of the indicators. Learn them well. Make sure that you know them. And I always say, AB,
Yes.
an ideal way of doing this is to draw them on a chart, stick them alongside the mirror where you normally groom yourselves every morning, okay? Make yourself look hundreds. And unwittingly, you're looking at those ratios and you remember them. It's not active learning, it's there. Unwittingly, you're reading through it as you are busy with your grooming, but at the same time, you're beginning to remember them, because remember, there's quite a few of them, and you have to know each one of them for the exams. One is, you walk into an exam room, and if you don't know your financial indicators, guys, I'm telling you now, you are asking for trouble. Make sure that you learn them well. Number two, you don't want to lose unnecessary marks by calculating the wrong indicator. Obviously, if they're asking you to calculate a particular indicator, you must know the ratio. You must know what involved in that particular indicator. Next, express your answers in the correct units. Remember that earnings per share, dividends per share, and net asset value per share are expressed in cents per share. Your return ratios are expressed as percentages. And many of the indicators are also expressed as ratios, as a ratio, 2:1, 2,5, 0,5 is to 1. Now, the stock holding period, the debtors collection period, your creditors payment period are expressed in days or in months, depending on what you used in your indicator. Right, so then you'll also indicate, for example, your stock turnover rate. You will express it as how many times per year. Okay, so all I'm telling you now is you must know, if I'm commenting on my current ratio, for example, I'm going to say 2:1, or whatever the ratio is, but that's how it is presented in your answer. Very, very important. Okay, now, when you're calculating a ratio, always express so that the right-hand side is equal to 1. For example, if your ratio must be calculated as 400,000 is to 800,000, you must express the right-hand side as 1. So in other words, you show your ratio as what? 0,5 is to 1, and not 1 is to 2. There's a distinct difference between the two. You want to know something is to 1. So therefore, 0,5, we say 0,5 is to 1. Okay, now, make sure you know where to find the information important for each of these indicators. Sometimes information must be, you must glean, you must get the information from your statement of comprehensive income. Okay? For example, just as an example, what would you find in your statement of comprehensive income? Remember, the statement of comprehensive income is your income statement, right? You may need your net profit after tax. So, where are you going to find it? In your statement of comprehensive income. By the same token, you may need to find other information where in your statement of financial position, here. And you know, for example, if you're looking for the total of your current assets, where are you going to find it? Definitely in your statement of financial position. So what we're telling you, grade 12s, is that know where to look for information. Why do you need that? Because when you're looking for information, remember, you're writing against the clock. The clock is ticking away. You can't be jumping from year to year looking for information. You must know where to find your information. And obviously, this would lead to success in this section. All right. Now, when you are commenting, you look at the mark allocation of that particular question. You comment in totality, right? We're saying comment as much as possible. If the question gives you last year's indicator, right? Make sure that you refer to it and say whether the ratio has increased or decreased. In other words, identify the ratio. For example, just to give you an example, if the question says, comment on the liquidity of the company, immediately you should know that they are referring to 6 financial indicators. What are these? They are your current ratio, your asset test ratio, your turnover rate of stock, your stock holding period, your debtors average collection period, and your creditors average payment period. Now, once you've identified those 6 financial indicators, immediately you must know, what do I do? Number 1, if I'm given last year's figure, compare, what's the trend? What happened to it? Did it increase? Did it decrease? What was the percentage increase? What was the percentage decrease? Is it good for the company? Is it not good for the company? Those are the types of comments you are expected to make when you are using and commenting on your financial indicators. Is that clear? I hope that is crystal clear to you. Okay. We move on now, and we look at the following. Remember, you are providing advice, right? And comments to the business based on your findings. Definitely, the different categories of indicators would include the following. What are we referring to? One, your profitability ratios. In other words, when you are learning your ratios, learn them in the various sections. So when the question says, comment on the profitability of the company, you know exactly this is what I need to comment on. I need to talk about the profit, etc. When you are talking about operating efficiency, again, look at the financial indicators and ask yourself, which ones of these fall under operating efficiency, right? So you can see that from this year, it's important to classify your financial indicators into various categories. I've mentioned, or I've alluded to the liquidity one already. Remember, when we're talking about liquidity, we're talking about the ability of a company to settle its short-term debts. That's what we mean by liquidity. Next, we come to solvency. When we're talking solvency, we are referring to the ability of a company or an enterprise to settle its non-current liabilities. Once again, liquidity, current liabilities. Solvency, non-current liabilities. Immediately giving you an indication that these are the financial indicators that I need to comment on. Remember, when we're talking about risk and return, obviously, there are categories of financial indicators. Amongst them, amongst others, would be your debt equity ratio, your return on shareholders' equity, etc., etc., etc. You need to learn those financial indicators, and you also need to know under which category would you place them. Like I alluded to early on, if the question says, comment on the liquidity of the company, you can't be talking about the debt equity ratio because that's the wrong ratio. Your liquidity ratios, like I've said, are those 6 ratios. They fall in the category of liquidity. Okay, Abraham, how's it going so far?
Yeah, we're doing well.
How much time do we have left for this segment?
I think we can just finish up and then take a break.
Can we finish up and take a break?
Yes.
Okay, guys, so in other words, what are we saying? We are saying that once you have learnt your ratios, now we're going to go into a question where we show you how to analyze and how to interpret. Got that, guys? The place to be, learn extra to be successful in your accounting exam.
Of course. Oh, you wanted to continue? Okay, let's take a break then if you need a break. Guys, if you tuned in right now, let me know on Facebook. Go to facebook.com/learnextra and send through all your comments and your questions about the show because we're here to help you guys and we've got this exciting competition for you matriculants. Look at this. Welcome back, guys. How exciting. You could win yourself 1 year of free accommodation courtesy of South Point Accommodation. All you need to do, it's simple. Fill in the entry form that I've already posted for you on Facebook and your name is on the draw. All the best, guys. You should win. But get yourself the notes, guys, because I know that some of you could be struggling on some of the questions. The notes are there for you. So download them, go to our website, which is learn.mindset.co.za, or ask me on Facebook, facebook.com/learnextra. Over to you, Ashraf.
Thanks, Abi. No questions?
No questions yet.
Okie dokie.
Let's
move on, guys. Okay. What I've done is I've isolated one financial indicator for you as an explanation. For example, if the question says, comment on the current ratio. What did I say? Number one, you need to know what goes into the current ratio. Your current ratio is your current assets is to current liabilities. Right. So immediately you know it falls in the category of liquidity, right? And the indicator is current assets is to current liabilities. Now, once you've calculated it, that's the first part of the story. What's the second part of the story? One, it shows you how many rands worth of current assets the business has for each rand it owes in the short term. Do you recall I said Liquidity deals with the ability of a company to settle its short-term debts, its current liabilities. There's it clear to you. Now, you would find traditionally people talking about this ratio being 2:1 or higher. Okay? Today, however, lower ratios are also acceptable. Why? Because of easier access to bridging finance. So, it doesn't mean that this indicator has to be 2:1. No, definitely not. In the economy that we operate today, bridging finance becomes very quickly available. And therefore, if you have a lower than 2:1 financial indicator for current ratio, it may be acceptable and it may be perfectly normal for the company to operate at that level. Okay, now, let's say that a ratio of greater than 1,5 means that the business is liquid, right? It will be able to cover what? Its short-term debts easily without any cash flow or liquidity problems. It's giving you an indication. If you have a ratio of 1,5:1, what is it telling you? It's telling you that for every 1 rand that you are owing in terms of short-term debts, you have 1.50 rand available. Clearly meaning that you can meet your short-term obligations with no problems whatsoever. Okay, now, let's go to the other extreme. A current ratio that is very high, okay? Let's say a ratio of 5:1. It appears, you may think it's good, but not necessarily. Why not? Look at the explanation. A current ratio that is very high might be bad for the business, as it could be investing those extra current assets in a bank or elsewhere, thereby earning a return. So a very high indicator does not necessarily mean it's good. So think about that. When you are commenting, look at the reasonableness, look at the situation, and based on that, you need to comment. Okay, remember that your current assets generally don't earn a return for the business. Keep that in mind. So obviously, that idle cash or that large stock figure that you may have may actually be a problem. So keep that in mind when you are commenting. Okay, now let's look at the question. In this question here, it says, you are provided with information relating to Classico Limited. The financial year end is on the 31st of October. New shares were issued on the first day of the financial year. What are we expected to calculate? We are expected to calculate the asset test ratio, earnings per share, return on average shareholders' equity, and the debt equity ratio. Those are pure application questions where you, as a learner, you are expected to do those calculations. Now just look at it. 7 and 5 is 12, 15 marks. Avi, would you take a chance for not learning your ratios?
No ways.
No ways, guys. Definitely not. Ensure that you learn your ratios. Immediately you can see 15 marks. If you know your indicator, you'll be able to get your 15 marks without a hassle. Okay. Then you'll also notice in the question, there are different theory types of questions based on that, which we will go through, right? They're telling you that Bongani is a shareholder in Classico Limited, and this was the story. He owned so many shares, calculate the amount of dividends, etc. We'll get through all of those questions. Hopefully, by the end of the show, we'll have answered all our questions. Okay, let's look at our information. What do we have? We have information extracted from the balance sheet. You see that? Statement of financial position. There's my information. Remember, important. That was last year. This is 2014 we're working with. So clearly you can see beginning of the year, end of the year, right? We also have information from our financial indicators for the past financial years as well. Can you see it? There again you can see 2013, 2014, important information, right? And then we are also given information from the income statement, statement of comprehensive income. Okay, now let's take a look at our first question. The first question says, calculate the asset test ratio. Now immediately you know, what is your asset test ratio? It is your current assets minus stock is to current liabilities. Okay, let's get this information. So there's my current assets, 4,804,000. So immediately I say fine. 4,804,000. That's your current assets minus what? Inventories. What were my inventories? 1,437,500. Therefore, 1,437,500 is to my current liabilities. Let's identify our current liabilities, and our current liabilities would be 1,450,000. So here we say 1,450,000. Okay, let's do that. So what do we have? We have 4,804,000, 4,804,000, right? Minus 1,437,500. 1,437,500 will give me a figure of 3,366,500. 3,366,500. What am I doing? I'm taking my total, my current assets, figure which I got from my balance sheet, minus my current liability, minus my trading stock. Why? Let's just do a bit of explanation on that one. Why do we take out the trading stock? Because it's the asset test ratio. The asset test ratio wants to know, can you meet your current liabilities without taking your inventories into consideration? And therefore we subtracted our inventories. Okay, so we got that is to 1,450,000. Okay, now what did we say? We want to ensure that this indicator is shown as something is to 1. Therefore, whatever I do on the right hand side, I do on the left hand side. So we got 3,366,500, and we say divided by 1,450,000, 1, 2, 3, okay, and it gives me an indicator of 2,32. Here's my answer. 2,32 is to 1. Now, in this particular question, all that you were asked to do was to calculate the asset test ratio. Do you understand what I'm saying? No comment was asked. Yes, if the question said, comment on the asset test ratio, then obviously, what are you going to do? You're going to look at your financial indicator, look at your asset test ratio of last year, 0.92 is to 1, right? Obviously, you're going to compare it. We said 2,32 is to 1. Clearly, you can see that there has been an improvement. So what am I doing? I'm talking about the trend, what happened from last year, okay? I can also say whether it is good. Clearly, from this year, the company would be in a position to settle its short-term debts without taking into consideration its inventories. So that's what is expected of you. Okay, so now, what we need to do now is to look at the next question. And we are calculating our earnings per share. Now, what is my earnings per share? Net income after tax. Immediately tells me, go and look for it. Where? In my information, net profit after tax, 975,000. Immediately I say, fine. Let's calculate that one. It's 975,000 over the number of shares that have been issued. Okay? And if we look at our information, we find that our number of shares that have been issued is 750,000. Okay? So therefore, let's go back to my indicator. It is 975,000 over 750,000. Remember what else we said? That this indicator, earnings per share, tells you that you have to show this indicator as 100 over 1. Now guys, this 100 over 1 is not a percentage, but so many cents per share. And that is why we multiply by 100 over 1. Okay, so let's do the maths there. It's 975,000 times 100 divided by 75123 to give me a figure of 130 cents per share. So this means that, watch, 130 cents, your answer has to indicate that it's 130 cents per share. That was your earnings per share. Now, while we're talking about the earnings per share, let's look at this here. If you compare to what you had, again, look at my earnings per share, 94 cents for last year. This year becomes 130 cents per share. Got that? Okay, now immediately you can see that there has been an increase. Again, if you are expected to do a comparison or you are expected to comment, that is what you're going to be doing. Okay, next question. Your return on average shareholders' equity. Now, once again, immediately ask yourself, do I know what's the financial indicator? What does it involve? Return on my average shareholders' equity. What do I take? I take my net income after tax, which we know was 975,000. Okay, so I've got my net income after tax over average. Immediately you put in a half. Why? When the question asks you for an average, they mean you must add beginning of the year with the end of the year. So the moment you see the word average, immediately it should ring a bell. Put in a half. Why? I want to add beginning of the year plus the end of the year divided by 2. So shareholders' equity. Let's find our amounts. We want our shareholders' equity. There we go. Can you see? 4 million and 4,450,000. Beginning of the year. There's my beginning of the year. There's my end of the year. So I add because I want an average. So it's 4 million. That's the 4 million beginning of the year plus 4,440,000, I think it was. Let's just check. 4,450,000. Okay. 4,450,000. 4,450,000. Okay. So what do we do now? Obviously, we do a calculation and we calculate our return on average shareholders' equity. Right. If you do the maths there, you're going to get a return of plus minus 23%. You can work it out. We're not going to do the actual calculation, but generally you should get a return of 23%. What does this tell you? It tells you as an accounting student that your return on this equity, it's giving you an indication of what the shareholders are getting. Remember, it's a returns ratio. It's indicating what they're getting from their investment. What return are they getting on the shareholders' equity? Keep in mind that shareholders' equity is made up of two components. What are my two components? My two components are ordinary share capital plus retained income. Okay, just to illustrate this point, one, so that you know what I'm talking about. Sometimes, for example, in this particular question, they gave you the ordinary shareholders' equity as a subtotal, but they could have left this out. Do you see that? Then you would know, or what you should know, is that share capital plus your retained income makes up your shareholders' equity. Got that? Okay. Next question. We have to calculate the debt equity ratio. Right. Now, what is my debt equity ratio? Again, I must know my ratio. Non-current liabilities is to shareholders' equity. Non-current liabilities is to shareholders' equity. Clear? Stated in another way, foreign funds, outsiders, non-current liabilities, loans taken from outside the company, is to own capital. Capital provided by the shareholders. Okay, now let's find that one out. Let's get the information. Here goes. My non-current liability is my loan from Freeport Bank, 2 million rand. So immediately I say fine, 2 million rand as my non-current liability. So we got 2 million as the non-current liability is to my shareholders' equity. Let's calculate our share. Let's see our shareholders' equity is given to us. Remember, 4,450,000. Therefore, 4,450,000. And if you do this calculation, you're going to find that you get an answer of 0.45 is to 1. What does this mean? What does this indicate to you? What conclusions do you draw from this here? The conclusion is very simple. For every 1 rand of your own capital that's provided by the shareholders, you are owing your non-current liabilities 45 cents. Okay? So this is purely, as you can see, calculations that you need to do application. So 1, learn the indicator. Number 2, take information and provide the answers to the required questions. Okay, when you come back, we're going to do some analysis and interpretation where you can see the types of questions you can expect in the exams. Don't you stray or go away. Learn Extra, the place to be.
Of course. Thank you so much, Ashraf. There's a great comment from Clifford saying, what would my education be without you guys at Mindset Learn Extra? Thank you, guys. And so Solomon Jan is saying, Hala, my star accounting teacher, he is the best. Hashtag Nyamuzo. You know what that means?
No, tell me what it means.
I'll tell you.
Please tell me.
Nyamuzo. Can you say it though?
Nyamuzwa.
Nyamuzwa. Yeah,
Okay.
I'll tell you after the break.
Thanks.
Think about it. Thank you so much, guys, for all those great comments. We'll see you after this break. Welcome back, awesome accounting Boffins. Now, if you think you are a Bright Spark, enter the Be a Bright Spark competition and you could win yourself that cool Chevy Spark L and you could be driving during these holidays that are coming. So guys, get entering right now. It's simple to enter. Buy yourself the Safeways K53 Driver's Manual or download the Cool 100 app, which is available from Samsung Galaxy App Store or the Google Play Store. For more details, ask me on Facebook and I'll tell you more about it because we love winning right here. I've got great comments and questions for you, Ashraf.
Good, let's go for it.
All right. Adelaide Hulisan saying, enjoying the show, thanks Mindset. Thank you, Adelaide. Katleo Steve Madihlabe, what is the formula for stock turnover rate? Please help me.
Okay, now remember, your turnover rate of stock or your stock holding period, remember, there are different indicators. Now, watch. One of them is you take your average stock over your cost of sales. That is your stock holding period. Okay, so it's average stock over cost of sales. Then your turnover rate of stock would now be cost of sales over average stock. So these two are very, very confusing because they use the same information, but you just need to know what are you calculating. Now, just on that one, another important aspect is that very often the question says, how long do you expect the stock to last? They're asking you for a stock holding period, AB, but they're talking about the final stock. Then you would take final stock over cost of sales and not average stock over cost of sales. So my plea to you is make sure that you understand what the question wants from you, and based on that, you can then use the indicator that is necessary. Turnover rate of stock just tells you how many times you're selling your stock in a year. Obviously, the more you sell, the better. Because it means your goods are selling well. If you're not selling well enough, obviously it indicates problems.
Of course, and talking about understanding the question, I promised you that I was going to tell you what Nyaguza means.
Yes.
It means I feel you, I understand you.
Oh, great, man.
Yeah,
it's
so,
really pleasing when you get that type of feedback.
Yes.
It shows that our learners are interested and they're listening to us, and we want to make a difference.
Of course.
We are the MAD team.
Yes.
You know what MAD stands for?
Yes, making
we
a
make
difference.
a difference.
Of course. Right. I've got another question. Zolile Sizana says, why is the high current ratio bad for the business?
Because you've got too much of current assets. You could have taken that money that you have in your bank account and invested it in a return where you would get a much higher return on your investment. Understand? Money is in your current account, bank accounts. You earn very little in terms of a return. So rather than leaving that money there in your bank account, take that money out, place it into a fixed deposit. Or invest in another investment whereby you will get a higher return. That's why we're saying a very high current ratio isn't always very good.
All right, Namnyaguza. Findile says, enjoying the show, thanks Mindset. My accounting has improved just because of Mindset Learn Extra. Thank you so much, Findile, and everybody that has sent us their comments and questions. We love helping you guys. We are the MAD team, of course.
Definitely. We want to ensure that you walk away out of that exam paper, once you've written your paper, and you are smiling from ear to ear, because definitely you are our accounting stars. Man.
Shining bright star.
Definitely.
Let's continue the question.
Okay, let's continue, guys. The question says, let's go up. The question says, the directors are proposing that the business operations be expanded in the new financial year. So they want to expand. Okay, so let's do that. We want to expand. And they're suggesting that the expansion take place by taking out a loan of R1 million. As you can see, there's a loan of R1 million. Instead of issuing new shares to the public, quote and explain 2 financial indicators to support this opinion. Now, watch this, guys. This is a classic question. Why? Because it's not giving you any indication of which indicator you have to use. So you now need to know that they're talking about a loan. The moment they talk about taking out a further loan, immediately, you should draw reference to the following indicator, which is your debt equity ratio. Watch, 0.34, and I think we calculated it to be 0.4. Let's check, we can find it there. We worked it out. We worked out our debt equity ratio, I'm sure of it. There's it, 0.45:1. Okay, meaning the following, watch. So, our debt equity ratio was 0.34 in the previous year and has now changed to 0.45. Okay. So what am I talking about? I'm talking about my debt equity ratio. Why? The question deals with a loan. So clearly from this question here, what can I see? Number one, the company is still credit-worthy. Although the debt equity has increased from 0.34 to 0.45, there's been an increase in this indicator. However, this company is still credit-worthy. It only owes 45 cents for every 1 rand that it has as shareholders' equity. Remember, non-current liabilities is to shareholders' equity. So obviously, what can you say? Your comments are definitely the company can still make use of loans. Why? Because in terms of the debt-equity ratio, so the indicator we are talking about here is the debt-equity ratio. Okay, so in terms of the debt-equity ratio, we still find in terms of gearing. Aha, important word. This shows us that the company is still lowly geared. What do I mean by that? By that I mean we have low risk. Lowly geared means low risk. If you look at it, the company only owes 45 cents for every 1 rand that it owns. So anybody would give this company some money. Why? If they go for a further loan, looking at the debt equity ratio, they can see that it's a low risk company because it's lowly geared in terms of its liability. The non-current liability tells you that this company is lowly geared. It's a low risk company. Okay, that's one part or one of the indicators. The other indicator, very important one, is the following. Return on average capital employed, sometimes called ROTSA or ROSA, whatever acronym you wish. Remember, it's standing at, last year was 18%, and this year it's 26%. Now, so the first indicator that we commented on was the debt equity. Remember, we dealt with that one. This one here, I'm going to explain it on this one here because we can clearly see what's happening. Last year, I had a return on average capital employed of 18%. And this year, I have a return on average capital employed of 26%. What does this mean? Remember, when you are talking about taking out loans from another, whether the company should take out loans, immediately you should have in the back of your mind debt equity ratio and my return on average capital employed. Now, watch this. Watch what I'm going to look for next. This means that I'm taking a loan from the company, which is part of my average capital employed. I'm using that and I'm generating a return. I'm generating a return of 26%. Clear? Okay. What do I compare that to? Here goes. My interest rate on loans. Why? Because I'm taking a loan from a company or from a financial institute, right? I'm paying interest at 12% per annum. Clear? I'm paying interest at 12% per annum. I'm using that money and I'm generating a return of 26%. Clearly you can see that from this indicator, it shows what we call, now please do not confuse the two. This is what we refer to as positive gearing. Why positive gearing? Because my return on average capital employed, watch, my return.
All right, Ashraf,
Yes.
there seems to be a problem with your mic, so as they try to fix it, I'm just going to address the guys watching.
Sure.
Right, guys, I must remind you that you should get yourself our workbook, which has the notes for you and the solutions. All you need to do is to send an email to sales@mindset.co.za. Don't forget that if you miss any of our shows and you'd like to get the schedule or when is what playing, because I've seen some of the comments from you guys asking us when is a certain subject being taught, we have the schedule for you guys. Go to our website, which is learn.mindset.co.za. And I must say that, guys, you should get yourself also the link to the videos that is on that schedule. Otherwise, I've got some great comments from you. I'll just go over them as Ashraf is getting ready. There's Amukelani saying, I'm enjoying the show. This is the best teacher ever. Thank you, Amukelani, for your comment. And Adelaide saying, enjoying the show. It is the best. Thank you so much. And also for your question and your comments, guys. We really appreciate them. Are you ready, Ashraf?
I'm ready, sir. Ready to fly.
Okay. As Ashraf would say, Mzwaki Nkosi is quoting you saying, when Ashraf is around, know that you must be fearless because he is the man.
Thank you very much. They're praising too much today, man.
Yeah, you're doing well today. I don't know why.
That's great. As long as they understand and we are making a difference to their lives, we want to ensure that you become part of the active economy of South Africa.
Of course.
That's what we want to do with you.
Of course.
Yes.
All right.
Definitely. Okay, guys. We were busy with the comparison. What are we comparing? We're comparing our return on capital employed, right? Remember, that return was 20, let's get it. That return was 26%. Okay?
All right, sorry about that. Well, guys, sorry about that technicality. Still send through your questions and your comment, and I'll go over your comments because we love engaging with you guys. Nonzuzo Amathe says, you just made my day. Wow, what a wonderful teacher. I can hear him. Hashtag Nyamuzwa. Thank you so much, Nonduduza, and all the other guys that are watching. I'll go over some of your comments because, you know, you love hearing your names as much as I also love calling your names, guys. Pindi Delma saying, enjoying the show. Thanks, Mindset. My counting has improved as well. You're welcome. And Bantu Biela says, I really have to watch this. I performed very bad on my accounting last term. I'm struggling. Well, Bantu, we're here to help you. Remember, you can get yourself the notes that we have for you on our website or watch our videos. The previous videos, you can also get them. We've got a YouTube channel that has the videos. So on the website, there's a link to everything for you guys. We've got resources for you guys. But my advice is get the workbook for only 139 Rand by simply sending an email to sales@mindset.co.za. That's so simple, guys, because we love giving you guys great stuff. Apart from that, we've got exciting competitions that we have for you. I told you about the Beer Bright Spark competition. It is closing on the 3rd of July, and the winner will be announced on the 21st of July. So get entering right now. You really don't have much time. So if I was you, I would get entering to win that cool Chevy Spark L. It's easy. Be a bright spark. Ashraf?
Yes, sir. Let's go. Guys, remember, we're talking about doing a comparison between two things. What are we comparing? You're comparing your return on total capital employed, which was 26% for this year, to your interest rate, which was 12%. Immediately you can see that when your return is higher than your interest rate, this is what we refer to as positive gearing. Now, please, guys, don't confuse yourselves. When you're talking about debt equity ratio, you're talking about high risk or low risk, right? Highly geared and lowly geared. But when you're talking about return on capital employed, you're asking yourself, on the amount that we are, on the capital that we're employing, that has been employed, rather, we are saying, how much return are we getting? We're getting a return of 26%. At the same time, we're paying interest at 12%. This means that when your return is greater than your interest rate, this is what we refer to as being positively geared. Obviously, your return is higher than the interest rate. Now, let's take this one step further. If, for example, the return was 8%, right? And this was 12%. Clearly you can see what's happening now. Now you have a situation where you're engaging the capital, you're employing the capital, and you're only getting a return of 8%. At the same time, you're paying interest at what rate? 12%. This is what we refer to as when your interest rate is greater than your return. This is what we refer to as negative. It is negative gearing. Why? Because we're not getting back what we're putting in. We're paying a higher interest rate than what we are generating on the return on capital employed. So keep this in mind, guys. Debt equity ratio, return on total capital employed. We're referring to level of risk, highly geared, lowly geared. When we're talking of return on total capital employed, we're talking about positive gearing or negative gearing. Okay. Bongani is a shareholder in Classico Limited, right? And he owns 32,000 shares, which he purchased 2 years ago at R4.75. We want to know what amount of dividend will Bongani earn from his shares. Okay, simple. He owns, what was it? 32,000 shares, I think. Let's just get it. Right, he owns 32,000 shares. So that's the number of shares that he owns. And what is the dividend? Let's check. Based on our information here, your dividends per share. Let's find our dividends per share. Here's it. 110 cents per share. In other words, what are we saying? We're saying that for every one share that you own, you're getting a dividend of how much? A dividend of R1.10. So in other words, if we look at Bongani, what can we tell Bongani? We can tell him that he's going to get a return of 32,000 times R1.10. In other words, we've got 32,000 times 1.1 to give us a figure of 35,200. What does this mean? It means that Bongani, as a return this year for 2014, will get an amount of 35,200. Okay, now, what is important? When you're commenting on these type of questions, also look at the relationship between your earnings per share, and your dividends per share, and you will also find that this relationship between earnings per share and dividends per share would have an impact on your NAV. What do I mean by that? If your earnings per share, say, just as an example, was R1, your dividends was 40 cents, clearly you can see that the company is retaining funds. They're making a profit or earnings per share of R1. They're paying out a dividend of 40 cents, meaning 60 cents is going to impact on the NAV. Why do companies retain profits? One, for future expansion and growth, and number two, for equalization of dividends. Unfortunately, AB is going to tell me, guys, time up. I hope you enjoyed the show. Please, my appeal to you is learn your ratios, practice your ratios, and be able to comment. Because if you do that, definitely you're going to be an accounting shining star.
Of course, thank you so much. And I remember you said the very same thing last year, that if you want to understand more of your ratios, you need to plug them in a paper, stick it into the mirror, try to memorize them daily, and there's no way you're just going to get them wrong on your exam.
100%. I totally endorse what you are saying.
Thank you so much. I took it from you. I listened to you. All the things that you say. I listened to Nyaguzwa.
Thanks.
Right? Guys, thank you so much. Unfortunately, we have to end it here. But it's been a great show. Thank you to the Department of Basic Education for making sure that we've got this show. We love you all and peace.